Hello, my name is Bob Kendall, Head of Retail Distribution for Deutsche Asset and Wealth Management in the Americas, and thank you for joining us for our first quarter update. I'm joined this afternoon by Dodd Kittsley, Head of ETF Strategy for Deutsche Asset and Wealth Management. Dodd, it's great to have you here.
Great to be back, Bob.
So Dodd, I have to obviously comment, fresh off an interview with Maria Bartiromo. You did a great job, representing the firm great, so it's great to have you here.
Yeah, it was a lot of fun.
Yeah, that's great. Dodd, let's just talk about really the themes that you're seeing in the ETF marketplace. I think we all see what an amazing trend and growth, but talk to me a little bit about what you're seeing in 2015.
Yeah, we're off to a phenomenal start. In fact, inflows were the strongest ever for the first quarter at $59 billion. But when you dig a little deeper, the composition is really amazing. We saw really a rotation among investors out of US equities and into developed international markets. Pretty material. We saw outflows in the US where we saw over $40 billion go into international developed markets. Moreover, when you go peel the onion one more layer, half of those flows were into currency hedged exchange traded funds. Currency hedged ETFs are now $50 billion in assets, which is unbelievable growth rate over the last few years.
Interesting.
Yeah.
Let's talk about what you see going really for the remainder of the year. Obviously, the pace that we've seen in currency hedged ETFs is outstanding. But talk to me about what you see for the rest of 2015. Does that pace continue? Are there other asset classes you think that really will come on strong as well?
Yeah, well, let's stay with equities. And certainly we do think that's going to continue. Both the demand for developed markets, and in particular Europe, maybe to a lesser extent Japan, and broad developed markets, we've seen a lot of growth, and we think that growth is going to continue because the theses are playing out in terms of increased earnings in Europe. It's really a perfect storm, but it's one where investors do want a currency hedge, and I think they're going to want to continue to do that. And at the same time, we're seeing increased awareness in the benefits that currency hedged ETFs can offer. So we certainly think that area will continue to grow through 2015 and even into 2016 and accelerate. Another area that we are very bullish on is fixed income. And it may seem a little counterintuitive with all the talk of interest rates rising and the Fed rising rates, but what's happened within exchange traded funds is there are solutions to help investors better prepare for rising interest rates. It's been an area where we've seen massive, massive growth. Already in the first quarter, over $20 billion have gone into fixed income exchange traded funds. But what's changed is the flows aren't going just in the short duration in anticipation of higher interest rates, but it's going to other strategies that help investors create a more holistic and better prepared portfolio.
Let's stay there and specifically talk about the fact that Deutsche has recently launched a series of fixed income strategies that really are aimed at exactly that, preparing clients for when we eventually do see an increase in rates. Talk about how the products work, how advisors that are watching might use those with their clients.
Sure, yeah, we launched 3 interest rate hedged exchange traded funds, one on high yield, one on investment grade corporates, and another on emerging market debt. And these are designed to give investors broad exposure to those segments of the fixed income market, but at the same time be able to protect them against the impact of rising interest rates. So essentially they are portfolios that own the underlying bonds in high yield, emerging market debt, or investment grade corporates, and also have an offsetting position in Treasury futures that neutralizes higher rates.
Now, before I let you go, I think for most of the advisors and investors that'll watch this, they're likely using ETFs somehow in their portfolio. But as a veteran of the space, talk to me a little bit about how you see the best advisors and the best portfolios constructed using ETFs.
I mean, ETFs are viewed by many as just really an expansion of their toolbox, a way, an avenue into the power of indexing, the power of passive investments, but they're being used by very sophisticated investors as a complement to active strategies, as a means to get access to areas where they don't know a manager, or there isn't a manager available, but also as a complement to active strategies in an effort to lower overall costs and be able to risk budget and control volatility that sometimes an active manager can introduce to a portfolio. When you look at the world's largest investors in the world, the pension funds, they typically blend about 50% of their portfolio in active strategies and 50% in passive, and both bring so much to the table, but it's very short-sighted to think of active or passive. It's really active and passive together.
Yeah. Well, Dodd, as always, it's great to see you. Congratulations to really all of Deutsche on the amazing growth of the ETF complex. I'll look forward to seeing you at the end of the second quarter.
Look forward to it, Bob. Thank you.
Carefully consider the fund's investment objectives, risk factors, and charges and expenses before investing. This and other important information can be found in the fund's prospectus, which may be obtained by calling 1-855-329-3837 or by viewing or downloading a prospectus. Read the prospectus carefully before investing.